Welcome back to another episode of Backholder Pod. So I think specifically for most Singapore-based investors, uh, at least based on the ETF that we are currently looking at, the Lion Philippe S-REIT ETF, the REITs have seemed to found some sort of a bottom in the end of October of last year, 2023. So based on the quick calculation, now it's at around 90 cents, where the bottom is around 77.6 cents. So that's around a 12-15% increase from its bottom. So I think there are a few driving factors around this current performance, mostly because it seems like we are taking, basically Singapore is an interest rate taker. We are not a setter. So we model after the Fed. So it seems like the US Fed has been signaling some sort of a rate cut. And inevitably, the rate cut will flow into the Singapore economy, lower the interest rate. There'll be lower financing costs, and I think for many of these REITs, it has been a headwind for the last 2 years or so because they have to renew their debt at higher rates, and I think financing costs increase, distribution per unit decreases. So right now, it does seem like the market is kind of trying to front run this entire issue. And I think the biggest question in most investors' minds right now, specifically those interested in the Singapore market, is can buy REITs now or not? Eric, I think we want to hear your perspective because you probably have the biggest REIT exposure here. So what's your perspective on this whole interest rate cut, how REITs are going to perform, whether DPU is going to be affected or not moving into 2024?
I think risk-wise, the earnings rebound might be quite muted though, because market is like predicting that the Fed will cut interest, right? But even with all the projected cuts, the interest rate is still going to be around 4%, which is historically, if you look at the REITs from like 10 to 15 years ago, the interest rate was close to zero. That's how they achieved that about 5% returns. So if you factor that in, right, like the 5% interest rate, some of the loans, they have not been refinanced yet. Some of it. I would say they refinance maybe about 20 to 40% because they always spread it out over like 5 years, their financing options. So now they've refinanced a portion of it, and then there's still that 60% more to go. Yeah. So I'm not that like hugely optimistic. I'm not rushing in like, wow, this is going to be a huge rebound. I think given that the market has trended up from about 12%, right? I think that is pretty substantial already. I think that is pretty much, I feel like, in the short term. Long term wise, obviously, I don't know what is the end result, but I think for this year, we're probably looking at a range bound. I don't see earnings like picking up, like going to the moon. Yeah. Bunti, what do you think?
Sorry, before Bunti comment, I stand corrected. Just now I did mental sum. I said 12 to 15. It's actually 16%. So it actually rebounded quite a fair bit. Yeah, Bunti?
Yeah, this whole things, right? I think before this rebound of the REITs and also the interest rate suddenly come reverse back down, right? We were just talking about REITs, and then I still remember my stand on it is that I'm quite bearish on it because like what Eric just mentioned, interest rate is higher, so less money flow to shareholders, probably less dividends over the coming 1 to 2 years. So that is still my stand. It's just that what is new compared to the last time when we talked about this is that suddenly there's this Fed U-turn, right? Since the December FOMC meetings, they kind of hinted that they will probably maybe 3 or 4 cuts in 2024. And also markets even overreacted on top of that. They are predicting that there will be 6 or 7 cuts this year. So all these things is like everyone making their predictions. No one know what will be the case because the FOMC or the Fed, they still have to track the inflations to make sure that the inflation is cool enough for them to really do all this cut. So I'm quite skeptical still. Like my base stance is that even if everything proceed according to what being predicted, the interest rate level is still high. Dividends may not be that attractive relative to the alternatives. And to me, the alternatives is always to put your money with let's say like T-bills, which still able to get you about 3.7 or 3.8%, right? So I think for now, like no plan to get back into REITs now. So yeah.
But if it's from a long-term perspective, do you think it's good to start maybe accumulating bit by bit?
Yeah.
Maybe I'll
Long
get Kelvin
yeah.
to share his perspective on it.
Long-term perspective is definitely now is a good time. Like interest rate is just going to go back down. And now now is a good time to buy. But whether it's the bottom or not, this one I'm still not sure. It's because like all the REITs, they are going to refinance at a higher rate, like what Eric said. So for example, like Fraser Logistic Commercial Trust, I think about 20% of the debt are going to mature in 2024. Fraser Commercial Trust, they have already settled their debt. They have already refinanced their debt for the 2024, but for 2025, it will be around 23%. By then, interest rates should go back down already, hopefully. So yeah, for the short term, it's definitely very muted. We are possibly at the near the bottom already. But I don't see it coming back up anytime soon. Long term wise, definitely it will go back up lah. But for now, is REIT a better choice versus like T-bills, SSB? T-bills definitely I would prefer REITs over T-bills. It's because T-bills is just very short term. You are investing in T-bills is because you want to lock in the high yields. You want to take advantage of the high yields. But for REIT, you are taking advantage of the low price right now. If if I were to use a better comparison, it'd be REITs versus Singapore savings bonds lah, where I could lock in guaranteed right now, I think 2.7, 2.8% over the long term versus REITs, which is like question mark right now.
But one more thing that I think we haven't talked about is that do you expect that over the coming 1 to 2 years, will the rental be revised upward? Because we have experienced this period when business economic activity all come back and then the rental normalize. So given at today's starting level, right, do you expect that rental to continue to go up? Because eventually all these costs, right, it will be passed back to the consumers, and are the consumers ready to pay a much higher prices on, for example, like dining outside, buying things? I think not so much so because I think nowadays people are using like Shopee, Lazada, all this to do your shoppings, right? But coming to physical stores, do you expect like to see the let's say your lunch, your meals all keep on increasing? I personally don't think so. I think that they were able to hold. I'm not saying that all this rental will be cut. I'm not expecting that, given that the recent GDP numbers from Singapore also is quite decent, right? So I think business wise is okay. It's just that I don't expect the rental to continue to climb significantly. So if the rental stay about the same or like rise very slowly, and the refinancing of the debt will be at a higher cost. So what it means is that the shareholder get less money. So whatever dividends yield that you're looking at, right, it may not sustain, or it may not grow. So as the dividends not growing, how much multiple are you willing to pay, right? So that's the questions that I'm asking. That's taking from someone who is more bearish on this asset class.
I think that's actually a good question though. But if I invert the question, right, from what Bunti said, so you're saying that people are not willing to pay the higher price. So what would be the alternative for dining specifically? It means they cook themselves at home, or they don't go to the malls totally?
Yeah, just alternatives. Buy more cai fan. Like spending less on these restaurant that because the cost cannot, it will pass to these shops, right, these restaurants, right, and as long as they are able to check up the prices, the whole thing will work out.
Okay, yeah.
Yeah.
So you think, in your opinion, because what are the alternatives like Kim Lee or whoever that owns the shops, the kopitiam and whatever, you think that they are holding the price for you, or you don't think that they're gonna jack up the price to the store owners and then they will jack up to the consumers as well? You don't think that's the case? Even for kopitiam to raise prices?
I would just say overall, people may spend less on those more expensive meals, which is in the shopping malls. So, but outside of those shopping malls, which is owned by REITs, right, you have all these kopitiam, small places. I think that is not outside. That is outside of the REITs ownerships, right? So people may go out from the malls and just opt for the cheaper options if they keep on checking up the price. Because I think one meal in let's say shopping malls, right, costs you, I don't know, now maybe 15, 20, $25. I don't think that's that's not very affordable? I mean, for now, still okay. Imagine it go up another 10, 20%, 30%. Can people still take it or not? Right? If people can't take it, then they will scale down the expenses.
Yeah, I actually I'm in agreement, but I feel like there's two forces in play here, right? So one is of course on rent reversion, which is the top line, and then the bottom line is the cost, right? So right now, at least what the market is expecting is the bottom line, the middle line, which is the rent, the payment of the interest. That line will possibly taper down, assuming that we hopefully go back to a low interest rate environment again. While at the same time, if there's a tailwind of rent revising upwards, so that's a double whammy in a good way lah, because top line is increasing and then bottom line is decreasing, so your margin is expanding. I mean, that's the long-term expectations if things continue going well. Economy is addicted to low interest rate, and then we go back, oh yay, happy again, then all the REITs will start printing money. But then I think what Bunti shared in a way is consumers, I mean, if we believe in the market economy, everybody will just react accordingly on their personal circumstances. If they're unable to check out rent prices, then all these REITs will suffer lah, because if the high interest rate environment continues staying high, then margins will not expand as per expected. But I do feel like at the end of the day, at least from a Singaporean perspective, there's really very little things to do in Singapore. What can you do? You think about it, what do you do during the weekends for normal people lah? Go to movies, go to a mall shopping. I don't know, more frugal people go kopitiam and eat. And then I don't know, go to the East Coast Park, look at the East Coast plan. I don't know what you guys, what else do we do? Only younger ones go to clubs and whatnot. So there's really very limited things that we can do at our availability. We have not much. The most we can do is to go to, I don't know, what's that called? Bukit Timah Hill. Whatever lah, the hiking spots are also, I think walk finish already. So back to the idea of the expenditure. I believe that as long as Singapore's economy don't go under, meaning if we are not very affected, or if the global economy still remains strong, hopefully China and US remain a very strong business partner, and we can continue printing money and real wages of Singaporeans go up. I think everything can be kept in pace. I think the biggest worry now is still a global meltdown, and everything will get screwed. But then on that same note, if there's a global meltdown, I think everybody will get screwed. So even the global equities market, your US, your Chinese stocks, everything will go down. So I think that's a kind of a very extreme impact. But at least for now, everything still looks good. I think GDP numbers, real wage growth numbers, everything's still okay. So I guess I'm not really hugely bullish. I mean, I do have REIT position, but it's small. I'm still monitoring and looking whether I can accumulate more for the long term rather than try to punt for a 10-20% increase. Then faster sell, I'll move on. I think that's at least not my game plan for now lah. Yeah, I hope I gave my perspective on this. Eric and Kelvin want to have ending thoughts on this?
I thought you were gonna share your recent moves.
Oh, no recent moves. So I was looking at it. I wanted to bet on, like I said, if as long as Singapore is okay, meaning touch wood, nothing happened, everybody keep their job, everybody happy. I do believe that a lot of these retail malls are quite strong contenders for monopolizing Singaporeans' activities. So I recently, I think for those of you who haven't followed, initially I had CapitaLand REIT and Suntec REIT. I acknowledge the fact that Suntec REIT was a lot more speculative because they have a lot of floating rate debt, and the leverage ratio is also not very optimistic lah. Like they're slowly creeping up 42, 43. I actually sold out Suntec REIT because I was not very comfortable with where it's going, and I took the loss. But I switched it out with Fraser Centrepoint because, like I said, I wanted to bet more on retail malls, and for CapitaLand it's retail plus office and whatnot. So I think from my entry, actually CapitaLand was not bad. I'm currently up around 10%, but it's not really my main point on whether I got in at a what. But more so, I kind of want to position the portfolio in a way where I have a good amount, maybe 5-10% allocation to REITs to slowly build up from there, because I'm still young. It supplements the entire portfolio to have a small exposure to the REIT position in Singapore. Whether is it from an FX position, because I'm living in Singapore, I need SGD, and more importantly, it's more of like a diversification play. So right now, I hold Frasers and CapitaLand REIT. The rest, I'm still studying. I think there are a few good names that Eric thrown out the other time, like Parkway Life and whatnot. I believe valuations also come into play, but yeah, I do see that rebound or uptick in terms of that 10, 15, 16%, because I see that the initial position are all up. So yeah, that's my perspective for my current play. Just note, don't go all in. I'm now maximum 2% exposure in terms of my REITs. Slowly accumulating and slowly monitoring. But yeah, Eric, maybe just a closing thought or something.
Oh, I can share a bit more.
Oh yeah, Kevin.
This is the Fraser Centrepoint Trust, the trade categories for Fraser Centrepoint Trust. When Punti was mentioning about the food and beverage, it's actually not a big part. Okay, it's the biggest part, but it's not the all part. It's just 30% of the entire thing. So like this is for Fraser Centrepoint Trust. Then for the other one, Maple Pen Asia Commercial Trust, food and beverage is a much lower percentage, about 12%. Yeah, so like when I see Singaporeans, right, whenever there's a raise in prices, like raise GST, whatever, they will say, oh, I'm going to cut down on my spendings, I'm going to eat less bubble tea, drink less bubble tea or whatever. Then the next week they're going to do the same thing all over again. And in fact, they raise their spending even more. So this is obviously a short-term thing. Probably even just a 1 week kind of effect of thing when Singaporeans go back to spending more money. But personally, I don't really like all the commercial REITs, like shopping. Like Singapore, how much more can you shop? Singapore's pay is not increasing that much even. Or if you include in inflation, their real wage is actually decreasing for the last quarter. So then here's the other thing. This is the GDP for 2021. I got a short notice. I can't find the latest one. Also for manufacturing, Singapore is earning the most money from manufacturing, followed by wholesale trade. If I were to bet on the industries that Singapore is earning the most money from, I will go with those kind of industry REITs that are involved in these industries. Mapletree Industrial, Mapletree Logistic. Oh shit, Mapletree Logistic, where it's more in line. I feel it has a higher upside potential as compared to just malls in Singapore. The companies there'll be more companies setting up shop. These REITs will be buying more overseas properties. Then in comparison, like all the Fraser FCT, Fraser Centrepoint Trust, Fraser Centrepoint Trust, like if you see their portfolio is like, I think it's 100% in Singapore, right? Like there's not many more growth that's going on, unless they go and bulldoze down some HDBs and some golf course lah. But other than that, there's not much growth going on for Fraser Centrepoint Trust other than just to raise renters. That's all. Which renters, all the other REITs can do also, ma. So yeah, that's why I don't really like the commercial REITs.
I think the main point is still what's your investment thesis lah. Because like Kelvin said, he want to look at overseas expansion. But I think one of the painful experience Eric had was when you expand to China and Hong Kong, they actually expand until it got destroyed lah. So it also depends on the manager, the REITs, what sector of the economy you're betting on. But personally for me, I'm more optimistic, or at least I look towards people going to malls, because that's what I want to bet on. Whether you want to do it, look at office REITs. I think there are some that are also betting. I mean, CapitaLand is also, they have some prime office in town now. But yeah, I think generally it's your own perspective and which horse you want to bet on. But I think generally most, as long as well capitalized, not a lot of floating debt like Suntec. I mean, Suntec was let's not talk about it. But you just need to take a look. I mean, I admit that I kind of screwed up in the analysis part, but yeah, that's just my perspective on looking at balance sheet, capitalization, the manager, the catalyst, and what sector of the economy you're betting on. I think that generally sums up the conclusion for what you look into for REITs. Yeah, hope you guys enjoyed the discussion, and we'll see you guys in the next video. Goodbye.
Bye.
Bye bye.